Okay, so we'll walk through each financial statement one by one. So as you can see that this is a statement of financial position, okay, and it's more complicated than the one you have seen in 2100. So basically, if you remember, financial statement of financial position is like a snapshot, right? It's like a picture, an image, rather than a video, right? So it's actually capture the financial position of a company at a point of time. At a point of time. So let's take a look. This one. Okay. So you can see that in this one, so the financial reporting timing here is December 31st, 2016. Okay, and so basically that's a point time, right? So on that date, okay, it's not for the year of 2016. Is the financial position on the date of December 31st, right? Okay, and so let's go through this. You can see that we have to separate current asset from non-current asset. Okay, so cash, receivables, inventory, this is all the current assets. Also, prepaid expenses, right? So these are the current asset has to be separately listed from the long-term asset. So you can see from here, long-term investment, goodwill, property and equipment, right? This is all long-term asset. Okay. So similar idea. Here. Oops, sorry. What happened? Sorry. Oops. Okay, here. So see here. For so for the liabilities, okay. For liabilities also you have a total current liability, okay. So that's separate from the long-term liabilities, right? So the typical current liability will include bank indebtedness, payables, short-term borrowings, okay, income tax payables. So you need to pay your CRA, right? The income tax payables, that's a current liability. And also the long-term debt, right, has a current portion, okay, has a current portion. I'm not sure if you remember in 2100, we are talking about, we are using the mortgage as an example, right? So the mortgage term will be considered maybe 25 years and 30 years. So it's a long-term liability, right? However, if the mortgage is paid monthly, so the next 12 months, right? The next 12 months is considered as current, right? Whatever you are planning to pay the principal amount for that long-term liability for the next 12 months is considered as current, right? So make sure you have to separate your current portion of your long-term liability. Okay, so you for the certain liabilities, you may have a current portion versus a long-term portion. Okay, and of course, the current liability will be listed separately from the long-term liability. Okay. Um, For the equity, for this equity, if I zoom too much, then it's, oops, you can see it. So for the equity, okay, so in the 2100, I think you only learned about two accounts, right? Common shares and the return earnings, right? But at the intermediate financial accounting level, you're gonna see more equity accounts. So basically, there are maybe four basic categories. Okay, so you have share capital, okay, and the contributed surplus. These two together is called contributed capital. Okay, here. And the return earnings is the same, right? We are really familiar with return earnings. And cumulative other comprehensive income. Okay, so this is a new concept. Okay, so this cumulative other comprehensive income is not considered as part of your profit or loss. Okay? It's not the fundings from the owners, right? The fundings from the owners are called contributed capital. The return earnings is the profit or loss from the operations of the company. Okay. Any other gains or losses in other transactions, those are called other comprehensive income. So this account, accumulated other comprehensive income, will capture anything that are not from the owner, not from the operation, okay, not from the business operation. So this would be kind of, the statement of financial position, balance sheet. Okay, the key here is the time, right? It's a point in time. Point in time. The total asset is also called a total financial claim. Okay, and the creditor claim is a liability. This is just different terms, right? The shareholders claim is the equity. Right? So you have a bunch of resources, the assets. It's partly due to the creditors, partly due to the owners. Okay? And make sure you present current versus non-current. Okay? Current asset, long-term asset, current liability, long-term liability. And also, the order of the listing, okay, from the top to the bottom, is following the liquidity, right? So cash and the cash equivalent is the most liquid item. So that's on the first line, right? So then investment, short-term investment. So you probably can convert this investment within 1 week, right? So that's quite liquid, but not as liquid as cash, right? Cash is, you don't need to convert cash for cash, right? So, and there are some flexibilities, right? If you are saying, guess what, loan receivables that can be paid, that will be collected within, let's say, 6 months, right? For one company, the inventory turnover is maybe, let's say, 7 months. So 6 months for the receivable, 7 months for the inventory. So you presented the receivable on top of the inventory, right? In another company, it could be different, right? It could be, 1 month's inventory turnover, right? So then the inventory is more liquid than the receivable. So there are some flexibilities here, right? So not all the companies has to strictly follow this order, right? Depending on how their account, the nature of the liquidity of their accounts, right? Okay, so let's move on. So the balance sheet is the result of the double entry accounting, right? You have known this already in the 2100. I'm going to just briefly give you some examples. So transactions in terms of exchange of one asset for another, okay? Then one asset will increase, the other asset's balance will decrease, right? So for example, you buy a land using cash, $1,000. So your exchange between current asset and the long-term asset, right? So your long-term asset land increased, you debit land for 1,000 and you credit cash 1,000. Okay. Second, exchange of one financial claim for another financial claim. So you borrow a new loan, okay, to pay out an old loan, $800. Okay, so this will all affect the liability side. You debit old loan, okay, for 800. You credit new loans for 800. You issue new shares as a stock dividend, $50 to shareholder. So the dividend, right? That comes from the return earnings. So you debit the return earnings, 50. You credit common shares. And last, increase or decrease an asset and a financial claim. So if you issue new shares to investor in exchange for cash, $40. You sell your shares to an investor for $40. Okay, so you are collecting the cash, debit cash for $40. You credit shares for $40. Hopefully, all these practice help you to refresh your memory about all the journal entries you have made in the 2100. Okay. So let's move on to the next statement of changes in equity. Okay. Statement of changes in equity. Okay. Okay. So as you can see that the four component I was talking about, four component of the equity. So basically, the share capital and contributed surplus here. These are called contributed contributed capital, contributed earnings here, return earnings, okay, and total cumulated other comprehensive income, okay, AOCI. In short, cumulative other comprehensive income, AOCI. That's also called a reserve. Okay. Remember, if the transaction is not from the owner, it's not the profit or losses from the operation. If there are some other transactions, that goes to this reserve. Okay. Okay. So what are some of the changes in equity? What are some of the changes in equity? So profit or loss. Okay. Profit or loss. So that would goes into the return earnings, right? Return earnings. OCI, other comprehensive income, that would go to the reserve, right? AOCI. Dividend, okay, dividend, that's a decrease in the return earnings. And the capital transactions, right? Capital transactions will be related to the contributed capital, right, from the owners, and the effect of the retrospective changes in accounting. Okay, so that would be, remember, we talked about if the change is change in accounting policy, or if it's a correction of error, we have to make the change retrospectively. Right? So that means the return earnings will be affected. Okay, the return earnings will be affected. So when there's such a retrospective adjustment, it's going to adjust its return earnings. Okay, and of course here the comparative information. Okay, comparative information at the bottom. So this is usually they would present comparative information side by side, right? But in this case, there are lots of columns for each year, right? So they are really running out of space, right? So they don't want to make this form too wide, right? Therefore, they're gonna 2015, okay, information instead of presenting side by side to make this form really, really wide, they present it at the bottom of the prior year number. Okay. So, but you need to have the comparative information. Okay. Okay. So then let's talk about the income statement. So for IFRS, they require the statement now is the statement of comprehensive income. So it's not just profit loss. There are some other comprehensive income. The statement for the under the IFRS is statement of comprehensive income. Okay. So at the minimum, you need to present the profit or loss, okay, from the regular business activities and total comprehensive income. There's some other comprehensive income. So profit, loss, okay, that's the regular earnings. And together with other comprehensive income, you have total comprehensive income. You can present it in one single statement, or you can have two parts. I'm going to show you the with some examples what I mean here. And for in terms of expenses, you could classify your expenses according to their nature and source, or function and use. Okay. So nature or source. Okay. So depreciation. So this is the use of the long-term asset, right? So the cost of using long-term asset is the depreciation, right? Cost of labor, right? You hire people. Cost of raw materials. For the manufacturing companies, you need raw materials to manufacture the goods, right? So IFRS required the classification of nature and source. Okay, so this is mandatory. Okay, for the expenses, you have to classify them into based on the nature and source. Okay, function use. Okay, is this expenses related to a sales department, to a delivery department, maybe administrative department, right? Okay, so you know, maybe the cost of labor. Okay, when we talk about the cost of labor here, we are saying the nature of source, right? A different department all requires employees, right? Sales department, we have salespeople. Administration department, we have admin people, right? So you can see how these expenses can be categorized differently, right? Categorized differently. If the function, if the categorization based on function and use, this is optional. Okay, you don't have to present expenses on the basis of the function. Okay, and you have to disclose earnings per share, right? in 2100, we have learned about how to calculate earnings per share. Okay, you remember that? And in the intermediate financial accounting, we're going to learn how to calculate basic earnings per share, okay, and diluted EPS. So this would be the topics to be covered in the second intermediate financial accounting course. In this course, we are mainly focused on the I side. Okay, for the long-term liability and equity, those topics will be covered by the second intermediate financial accounting course. Okay, so this is one example of the statement of comprehensive income. Okay, very good. We have comparative figures, 2 years comparative figures. The reason why we have this comparison is that this information is relevant, right? To make it useful, right? So the users can compare the 2 years, you know, to predict the future, right? To confirm the previous events. So you remember about the relevance information characteristics we talked about. So this is really helpful, right? The comparatability, right? That's enhancing the information characteristics, right? To make it more useful. Okay, so now let's take a look at these dots here. So cost of goods sold, delivery expenses, administration expenses. So these are categorization based on what? Based on the function and the use, right? So administration is a function, delivery is a function, cost of goods sold, right? So these are classifications based on function and use, okay? And this is optional, right? This is optional. So IFRS require classifications based on nature and resource. That's what here. So you see here, they use a disclosure, okay? So this disclosure of operating expenses by their nature, you can see materials, labor, and depreciation, right? So this information is mandatory, has to be disclosed, okay? Here, if you noticed, profit from continuing operation, okay? And there's a single line here. It's called income from discontinued operation, okay? So it happened that company may close a production line, right? Because that product is not very profitable, right? The company said, well, guess what? We screwed. We made a wrong investment decision. That product line does not generate revenue, right? We have to close it. So if you are planning to close this operation next year, okay? So going back to the IFRS framework, so the going concern assumption, okay? You are assuming, you know, the activities will going on, right, the next year. That's called going concern assumption. But if you know there is one operation will be discontinued next year, right? So that operation, okay, does not fit into your assumption. So to inform your user, you have to list it separately, okay? So that's why we want to separate the reporting, the continuing versus discontinued operation, okay? And there is one line here, income from discontinued operation. Okay, so that's very important. Now, moving to the left, I want you to focus on these black dots right here. These black dots marked this line as the minimum line, minimum line. Okay, so basically, these items are the minimum requirement. You have to have these lines of the presentation. Okay, first one, revenue. Of course, you have to present your revenue, right? And the finance cost, right? You borrow money, right? What's the cost of financing activities? So the interest expenses, okay? That's the finance cost. A share of profit or loss of associate. So you may have associate company, right? You invested into that company, okay? So you may earn the income from that company. Okay? So you have to make sure you list that income from associate separately, right? You don't want to mingle this income from associates with your revenue, okay? And then you want to report your tax expenses, okay? That's the income tax expenses. Okay, and then you calculate what's your profit from continuing operation. And then you represent your income from discontinued operation. Okay, and together, these two numbers together will be your profit for the year. Okay, so you need to have one line to indicate what's the profit or loss. Okay, and then other comprehensive income. Okay, so the income from other transactions. Okay, not from the typical operating activities. So in this case, net gains from securities classified as FVOCI. We're going to learn about this in the next, maybe in chapter 6 or chapter 7. Okay, we are going to learn about, what are the issues here. Okay, but this gain is considered as other comprehensive income. And then the profit, loss, other comprehensive income together, that's your total comprehensive income. Okay, total comprehensive income. So they present the profit and the total comprehensive income in one statement. Okay, in one statement. Okay, so this is, remember I talked about the statement of income, comprehensive income can be presented in one single statement or in two components, right? Okay, so in this example, it is presented in one single statement. Okay. Now moving to the bottom, the earnings per share, you have to report basic earnings per share and diluted earnings per share. You are going to learn how to do these calculations in the future chapters, either in the second intermediate financial accounting course. Note, right? They are dealing with continuing operation versus profit. Okay, so they separate the total profit. Okay, they listed continuing operation separately from the total profit. Okay, okay, so this is a very good example. Really tells us what are the basics requirements by the IFRS. What is expected for the statement of comprehensive income. Okay, so this is the income statement for Canadian Tire. Okay, so let's take a look. So they represent the revenue, good. They represent the finance costs. They represent income taxes, okay, tax expenses. Okay, then we have a net income here, okay, net income. And then they calculate basic earnings per share versus diluted earnings per share. Okay. So this is one component. And in the second component, okay, they started from net income. Here, this number is from here, 747.5, right? So, and then they considered other comprehensive loss of income. They have a bunch of items, and then they present the comprehensive income. Okay. So you can see this is an example of two components, right? In the previous example, they presented both profit and total comprehensive income in one single statement. And in this example, they used the two components, right? Statement. They use the two statement. One statement, they calculate the net income. And then in the second statement, they calculate comprehensive income starting from the net income. Okay. So let's take a look at this information. So the cost of producing revenue, okay, and selling expenses. This is all based on function, right? Remember, this is optional. The categorization by nature is mandatory. So you have to disclose the expenses by nature in the note disclosure, right? Raw materials, labors, remember. Okay, so interest expenses separately identified because it's part of the finance cost. Tax expenses separately identified, income tax expenses. I think there's a reason for this, because the user, right? Keep in mind the user. So creditors are the user, so they want to take a look at it. What's the interest expenses? And the government, maybe CRA, is also a user. They want to know what's the tax expenses. Okay, so for the second component, you always start with the net income you calculated in the first component. And then you include each source of the other comprehensive income. Okay. Again, we are going to learn all these stuffs. Right? Where are we going to get all these stuffs? And then you arrived with the other comprehensive income. Okay. So the last one is the statement of cash flow statement. Remember, we talked about the three activities, okay? Operating activities, investing activities, and financing activities. There are two methods to prepare cash flow statement: direct method versus indirect method. In 2100, you have learned about how to prepare a cash flow statement using indirect method. Okay? So there's another way to prepare cash flow statement. That one is called the direct method. So operating activities deals with current asset and current liability. Investing activities deals with long-term asset. Financing activities deals with long-term liability and equity. Okay, so keep that in mind when you think about, one account, right? If there's transactions related to that one account, where this cash flow should be reported, under which activity this cash flows related to the transaction should be reported. If that account is long-term asset, so then you know that it should be reported under investing activity. it's long-term liability or equity, then you know that it should be reported under financing activities. Okay, so you can see this is the picture of the cash flow statement. You started from operating activities, investing activities, financing activities. And then you want to know what is the cash. You have one line to summarize, to sum the three numbers. What's the cash used or generated in the period? Okay, and then if you add the beginning balance, okay, you should arrive with the ending balance of the cash. Remember, okay, so you consider the amount of cash used or generated under each activities, and then you sum up the numbers you calculated from the three activities. That's the total change in cash and the cash equivalents. And then you add the beginning balance, you should get ending balance, right? If your number does not agree with ending balance in the statement of financial position for the cash account, something's wrong with your calculation. So this statement is prepared using indirect method. Okay? And this looks familiar with you, right? So you start with net income. You make a bunch of adjustment, such as depreciation and the gain, remember? And then you talk about the change in the working capitals in AR and AP inventories, remember that? Okay. So that's how you get the cash from the operating activities. Okay. When you use a direct method to prepare this portion, that'll be quite different. Okay. Indirect method rely on net income. That's how they started. Okay. So direct method does not rely on net income. Okay. So under both methods, the preparation for the investing activities and the financing activities are the same. Okay? The only difference between the two methods are when you are preparing the cash flows from the operating activities. Okay? If we have time, I want to teach you how to prepare cash flow statement using direct method. Okay, so for note disclosure, okay, a lot of important information, transactions that will not be recognized in the financial statement, but they are important. They had to be disclosed for the benefit of the user, right? So that note disclosure has to include a statement telling the user that the statement is in compliance with IFRS. It's going to provide a summary of the significant accounting policies. For example, the inventory costing method, FIFO or moving average. Disclosures required by specific standard in IFRS. So, for example, we are going to talk about Chapter 4, revenue recognition. So the standard related to revenue recognition is IFRS 15. Okay, IFRS 15 have specific requirement for no disclosure. Right? We have to follow that. And disclosure to enhance understanding of the item reported on the face of the 4 financial statements. Right? Eventually, you reach that your financial statement is understandable, right? Remember the understandability, right? That's one of the enhancing information characteristics. So you want to disclose any information that is going to help the users to understand, okay? Understand of the items, okay? Comprehensive income, okay? That's a term only used for IFRS, not for SP, okay? So that's one of the substantial differences between IFRS and SP. In the SP, they only report profit loss, the income statement. Comprehensive income concept is only relevant under IFRS. Okay, so what's next? Okay, so I have this last slide. I think I want to mention about this accounting cycle. In the lyrics case study, they were asking you about what's the next step, right? Are you going to post all these transactions? Are you going to prepare adjusted trial balance, right? So I want to just quickly review this accounting cycle, right? So you start with generalizing, right? You record all the transactions event, debit, you credit, debit, you credit throughout the reporting period. Right? And you are going to posting these transactions journals to the subledgers, right? If you debit account receivable, if there's a journal entry, you debit account receivable, right? Then what happened is you're going to post that increase in AR into the AR subledger. Right? And then on the year end, right, you have to make some adjustment. Right? For example, you have to recognize the depreciation expenses for the year on the long-term asset, right? You're going to recognize a lot of the adjustment. So those are called adjusting entries. Those adjusting entries are only made on the year-end date, right? Remember? Okay, so then you're going to have adjusted trial balance. Adjusted trial balance. Okay. So based on the adjusted trial balance, you are going to prepare the financial statements. Okay, so that's your product, financial statements. Okay. And then, okay, you are going to close your revenue, your expenses into return earnings, right? Remember the closing entries? So you can restart the cycle again, right? Your revenue expenses will restart at 0 at the beginning of next year. Okay, so that's where you have to make the closing journal entries, close revenue and expenses into return earnings. Okay, so then you post the closing entries. Okay, therefore, that becomes the closing balance became the opening balance for the next accounting cycle. Okay, and then in the next reporting period, you're gonna repeat all these steps, right? Okay, so that's the accounting cycle. Okay, so that's it. So hopefully you will all have a chance to go through this video